The purpose of these, again, is to provide a running analytical commentary on what is happening with the economic crisis in general, but also with each session to focus on a particular aspect, so we get both an ongoing analysis but also some in-depth analysis of particular issues. The particular focus tonight will be on international aspects of this crisis. We're going to talk a little bit about how it is playing out in other parts of the world, what kinds of economic issues are arising in the relationships between the United States and other countries, and also how the crisis is being responded to by people in other parts of the world. So first, let me begin with a little update of a general sort and then plunge into the economic dimensions of the international parts of this crisis. Once again, also to remind you, we'll go for about an hour or so, have a short break, and then we'll have a general discussion in which you are all invited to ask questions, make comments, agree, disagree. You can throw things, but they shouldn't be heavy. Okay, in general, I would say over the month since we met last, a number of things have become clearer. Number one, that the combination of unprecedented monetary explosion in the United States, the creation of money and the heaving of money into the financial industry of the United States, particularly banks, that was the central part of the government's response to the crisis, has had an unfortunately short-lived positive impact. That is, the pumping of the money into the banks and the banking system provided a bit of a recovery for banks, large corporations, and the stock market, running approximately from March 2009 to about April of 2010. It has now stalled this so-called recovery, and so now the Federal Reserve has clearly decided, as much as anyone can tell, that a whole nother round of money pumping will become necessary and is likely to start next month, November, and run until mid-2011. That is certainly the consensus expectation of all the major banks in the United States, who are basing their policies on that assumption, and they usually know. There never was a recovery for the mass of Americans, so there's no danger of a double dip because they never had the upturn to make the dip double. They're just in a perpetual dip. The unemployment has not gone down at all. The rate of foreclosures, which was very high, has come to an abrupt end since last we talked, but not because of any decision of the banking sector, but because of the level of corruption and mismanagement of the entire housing boom that has now come to light. Since several of you asked me, I'm going to briefly describe it to you to save you the trouble of wading through all the literature. Basically, here's how it went. The housing boom, really lasting for the last 20 years, but particularly in the first years of this new century, was based on a new way of handling mortgages. People still went to their local bank to borrow the money to buy a house, as had been the norm in this country since the Great Depression. There was not much mortgage lending before the Great Depression because banks did not trust the public to lend them money. Okay? The reason we have a mortgage system of the sort we all take for granted is because of an idea of Franklin Roosevelt's cabinet during the Great Depression, which was that a way to get the economy out of the Great Depression would be to make it possible for masses of Americans to buy their own home. And the way to do that the government came up with was by guaranteeing the loans of the banks to the people. Now the banks would lend to people because they didn't care if the people didn't pay it back. The government would step in and function as an insurance company. That's why we have a mass housing market in the United States. That's why we had an explosion of suburbs. The notion that the American economy in the last 100 years is the creature of private enterprise unaided by the government is a fiction, has always been a fiction, and should not be taken seriously by anyone who's taken 15 minutes to actually look into the question. Our housing market has been dependent on the government for the last 80 years. And that dependence became even more complicated in the last 30 because the mortgage structure changed. The private sector took an initiative. And oh boy, are we paying for it. Here's the initiative they took. Banks, who had always lent to people, had held on traditionally to the mortgage. It was guaranteed by the government, so it was a good investment. They held on to it, and over the 20 or 30 years that an American family would pay off their mortgage, the bank would receive the monthly payments, which amounted to the interest on the loan and the return of the principal. This meant the bank had an investment in the family. It cared. It didn't want the government to come in and pay the insurance. That was a good thing to have, but they hoped that wouldn't happen because it requires paperwork and it requires some expenses, and it's not a desirable arrangement. Starting 20 years ago, a new development. Banks discovered that there was a way to make more money with mortgages than they had ever dreamed. And the way to do this was to create a new kind of security, like a stock. But it was different because it wasn't a share in a company that does something or makes something. Instead, this was a new kind of share, and if you bought it, what it gave you was a piece of a pool of mortgages, a collection of them, 1,000 of them. So some company, usually connected to a bank, would buy the mortgages from the banks. You all thought, if you had a mortgage, that your bank still held it because you kept paying monthly payments to the same bank. But the bank was no longer the owner of the mortgage. The bank was what you will now read in the newspaper as a mortgage servicer. All it does is keep the records and collect the money. But no sooner do you pay your bank than the bank ships off the money to the company that pays off all the investors who bought shares in that pool of mortgages. These are called mortgage-backed securities. They're simply a new kind of stock. And what this did, it allowed the bank to lend you $500,000 for your house. I'm going to assume you have that kind of money. So you signed a document. You now had a debt to that bank. The bank immediately sold that mortgage to somebody else, getting back its $500 and then looking for the next person to lend it to. Meanwhile, picking up a whole lot of fees and commissions for this rigmarole. Meanwhile, your $500,000 mortgage was pooled together with 999 other people's to create a special pool that investors around the world bought into. Who bought them? Americans and foreigners. Let me give you an example. Insurance companies took your premiums that you send in every month for your car insurance, and they invested in these things because they were very profitable. Pension funds all over the world invested the money kept out of your check for your future pension in this. Secret. In the months and years ahead, you're going to be reading stories about how the pensions of American workers they think they're going to get are not going to be there because the money was lost by investing in these mortgages. But that we don't talk about yet because, like many aspects of this crisis, it hasn't hit the newspapers yet. It's waiting for some new scandals. In any case, over the last 30 years, banks discovered that the money to be made in mortgages was by servicing them, packaging them, and shipping them off to investors. Of course, you now must wonder, why would an investor buy a mortgage of somebody he doesn't know? let alone 1,000 people he doesn't know. The banks understood that. They needed to sweeten the deal for the investors, and they did that in two ways. First, they went to special companies in the United States who are called rating companies or rating agencies. 3 of them completely dominate the market. Their names are Moody's, Standard & Poor, and Fitch. There are other companies, but their share of the market is trivial. These are the 3 big companies. So the people who made these pools of mortgages went, for example, to Moody's. Moody's, by the way, is a company owned by Warren Buffett. So the next time you hear about the genius of Omaha and the sage of Wichita, whatever the hell his names are, keep in mind this brilliant man did what I'm about to describe. The man or the company that made the pool of mortgages went to Moody's and said, will you please evaluate the risk? That's what these companies do. They evaluate the riskiness of any and all investments. And what Moody's did, which is what Fitch did, which is what Standard & Poor did, is attach a AAA rating to these pools, which meant that the company trying to find investors could say, here's a wonderful investment rated AAA by one of the great companies. There's no risk here.